Good morning, everyone. I hope you're all keeping well. For those who don't know me, my name is Tony Dickens, and I'm the Executive Professional Partnerships here in our Sydney office and your host today. My primary role is the management of the HLB community of metropolitan accounting practices, which I'll briefly cover following today's presentation. I'd like to extend a warm welcome to our HLB community members that have joined us today, as well as a large contingent of Joe Caleb's Australian Biz subscribers. I believe Joe's with us today and we welcome this collaboration and may well it continue. Today, Peter Bembrick, our tax consulting partner here at HLB Mann Judd, is presenting the very popular topic, using the small CGT concessions, share or asset sale. Further ado, I'll hand you over to Peter. Peter.
Yes, well, it's again appreciate appreciate everyone joining us. As Tony says, it's certainly pleased to get a large group, and so as Tony says, we're partnering up with Joe Caleb and Australian Biz, which is somebody who I've known for many years, and we've been collaborating with Joe for quite a few years now. So I'm situated up here in the sunny northern beaches of Sydney, and Joe's actually got his office quite close by. So we've even despite the pandemic, we've had a chance to catch up a couple of times recently, and so some of you that are on Joe's list may have seen the article that he's published in one of his newsletters on this topic, and that's on which this presentation is based, covering very much a practical focus on as we said here, share and asset sale, going through a couple of key examples and particular scenarios. And obviously small business CGT concessions, as you all know, is a very large topic. So we certainly won't cover every aspect of the area, and there's probably questions, I know, in a couple of the questions that have come through, and perhaps some of the questions that you may have that might be slightly off topic. We'll certainly endeavour to cover as much as we can towards the end of the presentation. But as Tony says, if there's anything that is a bit that we're not able to cover, we'll certainly come back to you offline. And but we welcome any questions that you do have, so that we can cover as much as possible. Do you have clients who are likely to within the next 3 years? So that's the question. To slightly set the scene on what we're talking about here today. I imagine a lot of you probably do, but if you get answer yes, no, or not sure, then that would be useful to get a snapshot of that. Okay, so that what we have there, as you said, if we see 66% yes, 7% no, 27% unsure. Well, it's again understandable that we don't always know exactly what our clients' plans are, and they may not know themselves. But certainly 3 years. I would think 2 to 3 years minimum was a good timing to start planning for an exit, possibly ideally longer. There's certainly a lot of things that you might need to do, but potentially restructuring. And if you've got an eye on these small business CGT concessions, which most of you probably know are very valuable, then you can look at whether you think they'll qualify or not. And if you can see that they maybe might not qualify for the concessions or maximise the concessions, there's often some things that are done to address those issues, so that by the time to a sale and the leakage, and obviously there's a lot of other benefits of planning as well for that sort of event. So that sets the scene really for our examples. If we can just perhaps just move on to the next slide, and we'll get stuck into the examples. So these are the facts that I'm starting with, and I'll vary them as I go through the examples. So we've got a company here, Better Productions Proprietary Limited, husband and wife, Lucy and Ian, 56, Ian age 57. They own all of the shares through their trust, which is a common scenario, and it can quite well. And in fact, often we find that if we have a structure where the shares are owned by individuals, sometimes restructuring to get into a family trust ownership can be useful. So, but assume that this was set up in a way that has the family trust as the owner of the shares with the two main individuals. Business 10 years ago, so it's 15 years, which course, you'd be aware there's a 15-year exemption, so we'll come to that further on in the presentation. But in this case, that the 15 years is not satisfied. They're both aged over 55, which again is relevant, and I'm not going through all of the individual criteria for qualifying for satisfying these small business CGT concessions, although I will address some of those in the course of the discussion. So you're probably more familiar than others with what the particular criteria are, but that may come up in some of the questions, or we're certainly happy to have any offline discussions with any of you about particular scenarios, and because there certainly are a lot. They're extremely valuable and powerful concessions, but there are also traps, so you definitely need to be ticking all the boxes. So again, just going through these examples, we have these facts. We have a net value of $4 million of this business, comprising some current assets of 300,000, cash, receivables, perhaps maybe even inventory, depending on the type of business. So, but things that aren't going to be the sort of things that are going to wash out on a sale and aren't necessarily going to produce a capital gain. You've got plant and equipment with a written down value of 200,000. As I said here, obviously some liabilities in there of 100,000, but most importantly, $3.6 million of goodwill. And obviously there could be other intangibles, but we'll just keep it simple and assume that all of the intangible value is in the goodwill, which is often the case. So then, importantly, Lucy and Ian are each receiving at least 20% of the trust's income, which as some of you may be aware, that allows each of them to qualify as a significant individual, which is certainly a key if you're selling shares. That's a very important criteria for small CGT concessions, that the seller of the shares is a significant individual. So and that only needs to be in the year of sale. So not so much, unlike some of the other grouping rules that look back at pattern of distributions, we don't need to go back to earlier years. It's a question of year of sale, which is one reason why a disclosure is such a useful vehicle to hold shares in a situation like this, is because you can plan for the sale, plan to ensure that the distributions are what you want them to be. And in terms of comparing these scenarios, Lucy and Ian both have a marginal tax rate of 47%, including Medicare levy. So obviously, even more important than that we can minimise the tax payable, and so and obviously the taxable capital gain after applying the discount and concessions where relevant. And so, assuming in this example the other criteria for applying the discount, the concessions are satisfied, the assets are active, the shares would qualify as an active asset, the various makeup of the shares, whereas particular criteria which I won't go into too much detail, but obviously make up around those. So so we move on. See if there's anything else to cover. We can go on to that next slide. So share sale. What happens in a share sale then? Well, firstly, the trust, we sell the shares for $4 million. The trust would make a $4 million gross capital gain. That's the first point. The shares have been held for well over 12 months, so the 50% discount would arise. So prima facie, the trust has a capital gain of $2 million. Then we get into what are the concessions, and this is where, particularly in an asset sale, it gets you need to really think through what the best approach is. But in a share sale, to give you a pointer to where I'm heading with this particular example, that there's a lot more that you can achieve, and it's often ends up being quite useful to apply the concessions at a share sale level. So the active asset concession, as themselves are an asset, that reduction applies to bring the $2 million down to $1 million. And then again, you can probably see why I've chosen $4 million as a value here. It keeps them under the $6 million, which of course has didn't mention that we're assuming here that the $6 million asset threshold, net asset value test is satisfied. Obviously, if you've got a business worth $4 million and they don't really earn too much else, apart from their family home and what they've got in super, then there's a good chance they're going to meet the $6 million net asset test. So it's high enough to meet, low enough to meet that test, but high enough to give them a pretty decent capital gain. And then as we flow through here, dollars, if both Lucy and Ian choose to apply the retirement exemption, noting that they each have a $500 lifetime, and assuming they've never applied it before, they've never sold a business before, that would allow the trust's taxable capital gain to be reasonable. And because they're both aged more than over 55, there's nothing that needs to be paid into super. Not really a misnomer, the name. There's no requirement to actually retire. So there's certainly no requirement to be retiring, but and there's no requirement to anything into super. But it's also, I guess, important to keep in mind that they've got the option to do that, and it is given the general limits on superannuation contributions, both concessional and non-concessional. It's a good way to get an extra $1 million looking at it from a family perspective. It's a good way to get another $1 million into super if they've got the cash to spare, because that $500,000 lifetime limit is in addition to their normal superannuation contribution caps. So that can be useful, but they can also just keep the money. It's entirely up to them. And in this scenario, they pay no tax. So that's looking pretty good so far. If we then move on to the next slide. Okay, so in an asset sale, just to sort of summarize, so here we've got to look at the individual assets of Better Productions because they're transferring them out to a purchaser. So Better Productions transfers the plant and equipment for written down value. It's usually the easiest way in this situation to just say, well, we'll just assume that it's worth written down value, and generally a purchaser is willing to agree to that as well. They'll just take it on at written down value. It's just, so there's no capital gain on, obviously it's not a capital gain, but there's no taxable gain on that. So, okay, so I'll probably backtrack a second. So I'll go to the top of that slide because I hadn't got too far. So we're transferring plant and equipment for written down value. Then current assets and liabilities, usually the purchaser doesn't want those anyway. So they're quite happy to leave those with the company that's selling the business. So the key point here is that really we've got a gross capital gain of $3.6 million that's made for transferring the goodwill that's made at the company level. Therefore, there's no CGT discount. So that's a key reason that we're for perhaps not having a company sell a business if possible. Better Productions can claim the active asset concession, which would reduce the capital gain down to 1.8 million. That can be a bit of a problem. It's really only a deferral because the tax-free portion of the 1.8 million will ultimately be taxed on distribution to the shareholders, will effectively be an unfranked dividend. So that doesn't work so well, and they may choose to skip that concession and just pay tax at the. It becomes a very tricky scenario, I guess, to look at what's the best. You have to do a bit more analysis as to what the best outcome is. Perhaps if the numbers are a bit lower, they might not apply the concession and just focus on maximising the retirement exemption instead. But if we assume that they do use that active asset concession, then Lucy and Ian can still claim their full $500,000 entitlement under the retirement exemption. So that reduces the capital gain at the company level by a further $1 million to $800,000. So then you move down to the active asset rollover. If you'll get situations where the active asset, the company actually does look to perhaps buy another business or put something into another active asset of some description, then they can. You've got 2 years to make that reinvestment. Otherwise, there's a 2-year deferral. So a 2-year deferral can be of some benefit, but after that 2-year period, if there isn't any sort of rollover into a replacement asset, then 800,000 will be taxable at the company level. So again, the retirement payments can be made into super, but they don't have to be. So the best case here really is an $800,000 gain. If you, on the basis that the Better Productions is a base rate entity, you're paying tax at 26% now in the current year. So we're down to $208,000, which can obviously then be used to pay franked dividends out of the after-tax profit. But the ultimate tax payable, so really we're looking at a $2.6 million distribution, really. So before claiming franking credits, so that's the 3.6 million gain reduced by the $1 million retirement exemption. So that's potential tax leakage as high as $1.2 million in total. So because the franking credits is merely getting a credit for the company tax paid, so it's really not a net saving. On an overall basis, we've paid $1.2 million of tax here, so that's not a particularly great outcome. So if we move on to the next slide then. Okay, so the verdict here to me is pretty clear. A share sale is clearly much more tax effective in this situation. Now, of course, the practicalities will come into play, and we've already got a couple of questions to that effect prior to the presentation, which and it may be. I've had situations where clients have been able to negotiate a share sale, but it's not always easy, and it's understandable that someone would purchase some buyer. There's a lot of baggage that comes with buying a company. There are ways that I can probably talk that with one of the presentation at the end, just so we can get through the material I've got here. But it's probably enough to say for now that there are obviously practical and commercial issues with selling shares, but there are ways that it can be dealt with. So it's worth raising the question with the potential purchasers, because people do, especially when you're dealing with larger, more sophisticated buyers, they will when you're dealing with larger, more sophisticated buyers, they will sometimes buy shares. You might just have to negotiate a little bit on the price and terms. But if you're saving over $1 million in tax, then perhaps shaving a little bit off the price or giving ground in some way is worthwhile. So something that needs to be considered. So okay. So we'll move on to situation 2 on the next slide. Same basic facts, except that Lucy's 46 and Ian's 47. So they're a bit younger. So then share sale, the outcome is pretty similar, except that the only real difference there is that the $1 million retirement exemption amount. So the $1 million retirement exemption amount. So it's just a question of and I've certainly seen a number of examples where someone's in their early 40s and you tell them they've got to put $1 million into super. That's not all that attractive. They want the money. They want to use the money for personal or for business purposes, and that is a real. So you've got to look at the specific outcome, and I guess the numbers, and see if weigh up perhaps paying a little bit more tax, paying some more tax now, and keeping access to the money against saving as much tax as possible, but having to lock some of it away into super, which they'll get it's beneficial. It's obviously tax effective in the long run, but the younger they are, I guess the more reluctant people are to do that. So it can become a bit of a call in these situations. But overall, it's still reasonably effective. So we'll move on to the asset sale, and again, likewise, same deal really. The outcome is pretty similar. The main difference being we have this limitation with the with the $1 million retirement exemption amount. So in fact, weighing them up is pretty similar. Sale is still much more. Probably the main the alternative to putting that $1 million into super is if a share sale is that could, if you invest at least $1 million into a replacement asset, like buying another company, then you need to, in that situation, you need to actually be paying $1 million for shares, or possibly paying $1 million for business goodwill or some other business assets. So as long as if they're prepared to do that, and particularly for people that are younger, they probably do want to go and buy another business anyway. So it's if they want to do something. So if that fits their circumstances, then that can work. With the asset sale, again, there might be up to 1 point, so it might be 1.8 million. But if they just choose to put the 1.8 million into a replacement active asset, then that's, there's possibilities there. So again, it's just running the numbers, saying, well, if we don't want to pay tax, and the alternative is to put the money into a replacement asset, and that would apply in any situation, but it's particularly relevant if you don't want to use the retirement exemption. So they have that limitation on how much they can pay. But under the active asset, they would obviously need to bring more higher in order to get that income. Okay, so now here we're going to look at a business that's been, and I've seen a couple of examples of this recently. So a business that has been operated for the 15 years. So you'd be aware that people would be aware that there is a 15-year exemption, which has a number of key requirements, and is certainly extremely valuable if you can tick all the boxes, and makes the gain completely tax-free, and can work whether it's a business selling a company selling a business or a share sale. They can both work fairly well. So there's more flexibility there, but it's harder to get into. So they've got to be over 55. They've got to be retiring, and I'll discuss that in a little bit more detail, because that can be perhaps one of the more difficult aspects to navigate, and that's one of the recent examples I've seen where that was a real that they had to think through as to how they were going to achieve that. In a simple example here, where they've got no ongoing role with the business for sale, then I'll just the next slide there. Yeah, so as long as and probably the box on the right hand side first. So the shares have been held for 15 years. They satisfy the active asset test, and actually that's one of the traps that I've seen in practice too, that you need to have things like, for example, with shares, you need to have had a significant individual for the entire 15 years. It doesn't have to be the same one. So they might have had people come and go within the ownership, but it's these particular shares that are being sold have to be held for 15 years. But there will be certainly there needs to have been that significant individual for the entire 15-year period. The active asset requirement has there's a couple of aspects to it. There needs to be needs to have been sufficiently needs to be 80% of the asset value of the business for at least 7.5 years through the period, 15-year period. Needs to have represented active assets. So what we see is things like large cash balances, or debit loan, Division 7A, debit loan, shareholder loan accounts. They're the sort of things that if they're big enough, can throw out the 80% ratio, and at a particular point in time, those shares will not be regarded as active. So that can be a problem. Also, if there are different classes of shares, I've seen again situations where people have issued dividend access shares. They can be cancelled, and in other situations where you're not using the 15-year exemption, sometimes that can be rectified before the sale. But once you really got to have that. If the dividend access shares are in place for a long period of time, then during those earlier years, those shares won't be regarded as active assets, and so It'll often be the case that you won't be able to use the 15-year exemption, and you'll have to then look at the other concessions. So there's certainly a few traps there, but if we don't have any of those traps here, and the sale is in connection with the retirement of either Lucy or Ian, doesn't have to be both, then the share, the gain will be tax-free under the 15-year exemption. And if it's, on the other hand, if some of the shares have been held for less than 15 years, and where I've seen that is where, for example, one individual's in business, they've held their shares for 15 years, but they might have had a business partner who exited at some stage. They got their family trust to buy the shares when he exited, and so the family trust shares have only been held for 10 years, only or less. So some shares are held for 15 years, some held for less than 15 years. So in that case, you're going to get a 15-year exemption on some shares, but not on others. So it's a matter of looking at the different parcels and seeing, well, how best can we apply these concessions. So it can be a bit involved, but obviously if you can tick it all the boxes, it's very worthwhile. So if we can move on to the asset sale scenario. Okay, so again, fortunately, there's a bit more flexibility here. So you look at it, the 15-year exemption is applied on a tax on the basis of who's the taxpayer. So in an asset sale, Better Productions is the taxpayer. So you look at has Better Productions carried on the business for 15 years, and say yes, it has. Is the sale in connection with the retirement of either Lucy or Ian? As in, is it? Do we have it? Is it in the? Is it in connection with the retirement of a significant individual? And so then the sale would be completely tax-free at the company level, and then there's also the ability for Better Productions as a second step can make tax-free payments to both Lucy and Ian and as beneficiaries of the trust. So it would be, say, for example, that Lucy's retiring, or say Ian's retiring. Let's just say Ian. So Ian's retiring, so he would get that, and then also he's a significant individual, and if Lucy's his spouse and she's getting at least some trust distributions, then she would also get the tax-free payment. So there's again, you need to work through the detail, but it can be done very well, and the entire transaction can be tax-free for them. So that can work well. So we just move on to the next slide. So this is the comparison. So in this situation, either approach will be completely tax-free. So we can look at, we can focus on the commercial, practical considerations. So it may be that, given what we raised before, they may prefer not to sell the shares because it's just too difficult. So they're happy to, someone's happy to buy the business, then do that. That will work well. If all the shares have been held for 15 years, if the shares have been held for, if some of the shares, as I mentioned before, have been held for less than 15 years, then this is where an asset sale can actually have the edge. And this is the, I've had a recent live example of that, but that's exactly the conclusion that we came to, is that instinctively we always tend to lean towards a share sale if possible, but in this particular situation, it was actually better to look at an asset sale, because in that previous slide said that you've only got to get in. You get in under the at the company level and make it tax-free, and then the company can make tax-free payments to the shareholders. And the fact that there have been changes in the shareholding in itself don't necessarily stop the entire sale from being tax-free. So that does give this an edge. And then so it's just, so this is where you have to really do some careful analysis, and and it has the advantage of being more tax effective unusually, and also easier practically. So so that's situation 3. Yeah, so we'll go on to 4, and this is where we're getting reasonably close to the end of the material that I've got. So we'll definitely have a bit of time to cover some questions. but I'll just go through this last scenario, which was the variation on the previous one. So in yeah, so again, similar thing. We've got the business that's been operating for 15 years, but we have this very common situation where so Lucy is the driving force behind this business. She's effectively been running it, driving the growth of the business. Ian is really more of a part-time office manager, and so the purchaser wants, and naturally the purchaser wants Lucy to stay involved, to work in the business. So Lucy's going to continue to work in the business. They really want it for 2 years, helping to drive, obviously, transition key clients, continued development of current projects, growth, and then, of course, integrating the operations into the existing business that's carried on by the purchaser. So it's a key part of this deal that Lucy helps them in this process, and that's exactly what was happening in the live example that I referred to a minute ago. And they wanted that key person to remain there for 2 years. There was discussion around, well, if it was, how can we regard this as being part of their retirement? So in this case, part of Lucy's in connection with Lucy's retirement, if she is going to retire at the end of this period. If it was, say, 6 months, if it's a few months and she's cutting back her hours, can that be regarded as retirement? And there's some guidance from the ATO, but it's not entirely clear, and it's one of those areas there's been private rulings in this area, and it's if you've got a client in this situation, you probably want to consider applying for a private ruling on their facts and on it's the idea of retirement, and what does in connection with their retirement really mean. The feeling was in this particular example that keeping up quite extensive hours for the next 2 years and being very much involved in the business is probably a stretch to call that, to say that this sale is in connection with her retirement. It's probably a bit too long, but if this is the key to the tax outcome, you may still want to test that with the ATO. But fortunately, the alternative approach, which seems safer, was to look at Ian and say, well, they don't really need Ian going forward. They've got their own admin that they can just integrate that into their business already. So if we can look at that as Ian's look at this sale as in connection with Ian's retirement, that should be enough to get them across the line, and then Lucy will come into that as Ian's spouse. If these were business partners and weren't as opposed to being spouses, then that wouldn't work. You would be looking at you'd have to look at their situations individually, but because they're spouses and they're getting distributions through the same family trust that owns the shares, then you only need to establish, as I mentioned before, you only really need to establish the retirement of one of the spouses, and in this case, Ian is the easiest one. So that's the analysis that helps us get to an answer here. So if we just move on to the next slide. So as I said, Ian will qualify as a significant individual because he receives at least 20% distributions in the year of sale, and Lucy still needs to receive something. She won't be a CGT concession stakeholder in terms of the small business CGT concessions if she doesn't receive anything at all. But being Ian's spouse and receiving even $1 of trust income in the year would be enough to get her in there. So most likely they're both going to receive reasonably significant distributions. You might have, what sometimes happens is you might have children, 1 or 2 children who are at university or in their early 20s or something, who are also receiving some distributions. So there's nothing wrong. That doesn't stop this all working, as long as Ian and at least Ian and possibly Lucy get to that 20% mark in the year of the sale. So that's in these sort of closely held situations, that's not usually too difficult to arrange, and probably going to happen anyway. So as I mentioned before, the 2-year arrangement with the purchaser, it's probably unlikely So you, again, hopefully try not to hang your hat on this one if you don't have to. That this sale would be regarded as in connection with Lucy's retirement. But it's a pretty reasonable suggestion that it's in connection with Ian's retirement if he does genuinely retire. And now the other question that came up in in the real life case is, well, could Ian get another job? You know, getting another part-time job, or it's probably nothing. It's probably nothing that necessarily specifically prohibits that. It's certainly there isn't it's not a black and white requirement that he has to retire and not work at all, but it's obviously cleaner if that's what happens. But you know, so again, it's a matter of just case by case looking at it, and if Ian is doing a little bit of work, that's not necessarily a problem. But I think you'd want to, it would be best that he ceases working for this business, definitely, and then ideally not work at all. But again, it's not so black and white, so you just look at that. But you want to make the best possible case to claim this concession, and the outcome is that the entire sale is tax-free, and again, just so there's no requirement to put anything into super under this 15-year exemption, but it's certainly feasible to, and again, there's a very large, I forget, I don't know off the top of my head what the number is, but there's a very large amount limit of that can be used under this concession that allows you to put extra money in super on top of your normal non-concessional amount. So if they're looking to get it up if someone's looking to boost their super much higher, a $1.6 million cap and to get a large amount in that they can ultimately receive a tax-free pension from, then this is one way that they might look to try and do that. So, but that's entirely voluntary. So move to the next slide, perhaps, just to very similar. Again, Ian will be a significant individual. Lucy will also receive a distribution. Same discussion around the retirement requirements. There's no difference there. The thing about an asset sale is as on before, there is this second step that firstly the sale is tax-free at the company level, but to get the money out, then the company has the ability to make tax-free payments to Lucy and Ian in their capacity as beneficiaries, and that makes because of their situation, and then that makes the entire transaction tax-free for the individuals. So so you can get the money out. That's the key. So you can put them in essentially the same position as if they had made a share sale. So then we move to the final, I guess, the analysis of this case study, which is again, either situation is tax-free. So it comes down to the practical commercial situations, and the same point in relation to certain shares not being held for 15 years. Then again, there may be an incentive to go with the sale for that alone, as well as perhaps also because of the practical and commercial outcomes. So that's to the end of the technical points that I wanted to cover. So I think we move on there. And so the summary, I suppose, of all of that, to bring that all together, is that in most closely held businesses, the share sale is usually what we look at. It's generally more tax effective. As we've illustrated, there can be problems with selling out the business assets, but of course there are commercial, legal issues that will make that, would be pushing towards an asset sale and pushing the purchaser, and it may be that they just won't buy a company, and that is a common comment that's made. So it's a matter of just saying, well, is it able? And the last time I had that discussion with a client, they were of the view that they knew the purchaser well. They sat down and had a discussion with them, and they came to that agreement fairly quickly. That middle point there, with a share sale, the individual owners, whether it's directly or through a family trust, can usually use the CGT discount, and then you've got the active asset concession can be used effectively, which whereas it's really not that effective in a lot of cases, apart from the 15-year exemption. The active asset concession is, well, obviously that's a different story if it's the 15-year exemption, but if you can't access that, then the active asset concession is not usually that effective within a company sale, whereas although the retirement concession is, so that makes the situation easier in either case. But certainly using all of them in relation to in a share sale can significantly reduce or eliminate the CGT payable there. And as we've just been discussing, the business sale, that's the main scenario where a business sale might be more effective under that 15-year exemption if you've got some shares that haven't been held for 15 years or more. So it's just a matter of, I guess, just looking at that scenario, and I suppose the other point there with a share sale is that it can be the grouping. Certainly, the grouping is another factor when you're looking at connected entities and affiliates, which is to work out with it when you apply this. We've used a very simple example where it's one family and the $6 million net asset value threshold test is satisfied. But if you're dealing with, say, two business partners, and again, I've had the recent example of that where they did do a share sale, they were able to negotiate that. But if one of the owners clearly has way more than $6 million, he was never going to. He can get the discount, so it was still a worthwhile share sale. Was still worthwhile for him, but he'd be well over the $6 million in his own right, let alone when you group the business in with him. Whereas the other shareholder was below the $6 million level. So when you they were 50-50 owners. So but when you connected his assets with the business, you're still under 6 million. So he was okay on that front. But if you did a share sale, if you did an asset sale, then you'd be looking at it at a company level, and you'd be grouping that company with basically both owners, and you'd have to look at all of the you'd have to essentially connect up all the assets on a 50-50 basis of both of the principles of the business, and so that would take these concessions off the table completely for an asset sale, whereas at least in a share sale it was beneficial for both, and even more beneficial for the one who doesn't have as much in the way of personal assets. So that is so that is the end of the presentation there. I think it's taken us right up to the question time. So okay, so I guess this is relevant certainly. Firstly, so Ratner's question is, if a private company sells its business and a client is looking to utilise the CGT retirement concession, which entity has to lodge the election to contribute the CGT into a super fund? The company or the shareholders, directors? Believe it's the company. So okay, so yes, this is the only election that has to be made in writing. Generally, a choice to make a say use the active asset concession or the 15-year exemption or anything. Generally, there, as with a lot of choices in the Tax Act, they're just choices you make, and then that's evidenced by what you put in the tax return, essentially. But as you point out, Ratner, there is a requirement to have that in writing. So as you say, the company would need to. So the company's making a payment into super. So it would be the taxpayer. So as you say, the company would have to have an election to say that, well, I'm making a retirement concession payment, and choosing the retirement concession. Now it's certainly needs to be disclosed in the tax return. I don't believe you're actually lodging the form with the election form with the ATO, but you certainly, I think it fits with your question. It certainly needs to be completed in writing, and that needs to be held on file. And if you don't have that election, then you haven't validly satisfied the requirements. So hopefully that answers your question. So then Bruce has a question here. If an asset sale could defer or be cleared by a share buyback, that would provide some of the benefits of the share sale. Buyers often do not want the shares. Well, obviously that's fair enough. Okay, so when you say share buyback, I'm not sure whether that quite works. Perhaps some of the benefits of the share sale. I mean, certainly whatever whatever cleaning up you can do. Well, certainly, firstly, I guess you've got 2 years to the capital gain. So that there would have to be, the company would be making the capital gain. So certainly the company would have to be acquiring an active asset. So I don't necessarily think a share buyback itself would, because all you're doing essentially, I mean, the company's buying back its shares. So it's not going to actually be reinvesting the proceeds in an active asset going forward. It would have to be something going forward. So what a share buyback does is essentially give back the proceeds to the shareholders, and of course that's not always a capital. Sometimes it's partially in capital, partially in dividend, in the form of a dividend. Yeah. So I haven't actually seen that done. I'm not sure that would exactly work in the sense of the capital being returned to the shareholders, because you're not actually buying a replacement asset. Because the replacement asset then needs to be active. So no, I don't think that would quite work in the way that you envisage it. But if you've got a follow-up comment, I'm obviously happy to explore that further. But I might just come back to that one if there's anything further to discuss. Okay, so I'll just move on to Mark's question to keep this moving. In practice, how can you verify that more than 80% of assets have been active? It's a very good question here. For more than 50% of the period of ownership when there have been cash holdings and directors' loans, are expected to trawl through 7.5 years of prior year accounts. Well, that's exactly what you're expected to do, Mark. And I've had, or perhaps 15 years of 15 years payable, or it might have been in place for 12 years, and you're expected to go through 12 years. But it's whatever the history is. You are expected to have balance sheets, and I've had to do this where, the company might have changed accountants 2 or 3 times in that time, and so what we're asking for to do the advice is copies of balance sheets. Now technically it's on a sort of a days basis, so you could look at, well, how did the assets balance change during the year, but in a practical sense, what you're looking for is, I guess, year-end balance sheets, and you're trying to extrapolate, well, how did that change? And if you can see on one date it's okay and another date it's okay, you assume that it was okay in between as well. But there's really no other way to do that but than to be able to substantiate that for a certain period of time, as you say, Mark, 7.5 years, and you have to make some assumptions. The other difficulty there is you've got to make some assumptions about the value of the business. You haven't got, private companies don't value their business every year. So there's a lot of assumptions that need to be made probably too, because obviously the goodwill value will have a significant impact on the 80% test to see whether the shares are active. But as you say, if there are large cash holdings and directors' loans or shareholders' loans, that will cause an issue with it, and you've got to just go through whatever records you've got and do whatever you can to get to the best answer you can. So, and if you can't do that, then unfortunately you're going to have difficulty passing the test. Unfortunately that's the bottom line. So I might just move on to the next one. This is an anonymous attendee. Okay, so in situation 1, would all your answers be the same if the individual was 75 years old? Okay, so there's no age limit if the individual wants to put their money into the super fund and the SMSF. So now you do need to. Now I'm certainly no superannuation expert, and we might take that one offline to just double check with our superannuation team. I mean, the key to that question really is, can you put the money into the super fund? The answers on the CGT side of it should be the same. It's because, and obviously at that sort of age, 75 years, there's no requirement to put anything into super. I think the key part of your question is, can you put the money into super? And that's really more of a superannuation question. So I'm not 100% sure on that one about the age limit, but we might see if we can find that out. If you can give us your details, we can come back to you on that specifically. But I haven't seen that scenario specifically, so I'm not quite sure. I'll just keep moving to try and address the main CGT aspects. So another one, if the client elects to use the 2-year rollover exemption to defer the super contribution. When do they need to make the super payment? Okay, well, yeah, so you can use these exemptions in different ways. So certainly, yeah, if you defer the exemption first, then it is, as implied in your question, it is possible to apply the retirement exemption at the end of the 2 years instead of putting instead of applying the or instead of paying the tax. So it's when the CGT, we have to be when the CGT event arises. So there's obviously that deferral, and you've got it's 7 days after the due date for lodgement of the return is when the election needs to be made. So you've really got to look at, well, when's the return due for the year in which the capital gain is going to arise, and that's when you've got to be looking to make the super payment. So I'll just say about Bruce. I'll go on to Bruce's question here. So if shares are active assets, then the share buyback is disposal by the shareholders of an active asset. Okay, so this is a comment that Bruce is making. Shares are active assets, and the share buyback is a disposal by shareholders of an active asset. Shareholders get the cash out of the company without being taxed as a dividend. Right, okay, so that's what you're saying. You're not saying that there's a shares business sale. The thing is, though, you're not selling. If you're selling you've got to look at what's being sold, though. If the company is selling its business across to the I mean, if the shareholders are taking it out, if the company is firstly selling the business across to a third party, then that's an asset sale, and I think I would think you need to look at that, the treatment of that first. If there's then an active asset, if there's then a share buyback, then perhaps that can be, perhaps the CGT concessions can be applied to that. And I'm not suggesting they can't be. And the same, likewise, if you liquidate the company, and this, I know I got a question on that prior to the presentation that was sort of where that was sort of relevant, that it is actually possible to get 2 goes at the CGT concessions. You can sell the asset, you can have an asset sale and sell the assets out and apply the concessions that way. And then what you've got left then is cash in the company, and how do you get that out? Some of it needs to go out as a dividend if you've paid tax on it, but then there's an element of, to the extent that there are capital payments being made and you've got to distinguish very clearly between distributing profits and distributing capital payments, but to the extent that there are capital distributions on liquidation, then that can allow you to claim the small business concessions on the liquidation. So that's something that can be, so it is possible to get sort of 2 goes at it, but then you don't get the full benefit. You only get perhaps a partial benefit. There'd be some perhaps tax payable, but at least you'd be able to reduce it. So I think my answer there, and again, I haven't had to apply is that you would get you may get it. You may be able to apply them on the share buyback, but if there's an external asset sale, you need to deal with that first, and probably look at them as 2 separate. That's the way I see it. Okay, so Christopher Roseman, if we just jump to that one here. So Klein and his wife own shares 50-50 since 75, so pre-CGT. He's 75, his wife's 65. Obviously understanding about the pre-CGT. So yes, so you're right, Christopher. The idea that if you sell, so typically you wouldn't be worried about these concessions if the shares are already pre-CGT, but if you're losing the 15-year exemption, and you sometimes want to apply, you might want to apply these exemption in order to make some super contributions, and that's probably the main reason you might do that. So I agree with that. And he said the client has a $1.6 million Div 7A loan. Does he need to pay it off, or can he liquidate the company with the Div 7A loan balance? Well, the Div 7A, any loans would need to be extinguished as part of, of course, that could have a bearing. The Div 7A loan may have a bearing on the 80% test, but assuming that's still been satisfied, then, well, the Division 7A rules would apply, so you would need to deal with that. it could certainly be satisfied as part of a liquidation, and that see that quite a lot. But again, you just still need to look at the liquidation components and how that all plays out. So so I think, yes, a lot of what you're just suggesting, Christopher, can be done. It probably depends on the detail, and that's something that you probably happy to discuss with you offline, but probably need to look into that, the fine detail of that one. So we might, I think, Tony, we might have to cut it there.
Yep,
I'll just
we'll wrap
hand
it up.
it back to you to close things off. And,
Yep. Okay, well done for getting through that, Peter, with those little technical issues we had. So look, I'll take 1 minute and then we'll let you all go. I just wanted to give you a quick overview for those that are attending that aren't already community members. I thought I'd just, to those accounting practitioners, I'll give you a very, very brief overview of the community. It was established several years ago, and it's grown considerably in the last 2 years. The simple objective of the community really is to allow small metropolitan firms in the HLB community to better service their clients by accessing our technical and networking resources. I'm a dedicated resource for the community, and we don't have any gatekeepers in the firm. Peter and a number of our partners and directors are always available. I encourage community members to have a relationship directly with people like Peter, but of course, any of them can come through me, and they do from time to time. There's no membership fee. It doesn't cost you anything to join the community. There's no paperwork. We have a discussion, we tell you about it, and if it's something that you think is worthwhile, then we literally put you in our system, sign you up, and off we go. I mean, you get some of the benefits include having access to our network of experts, obviously seminars, training sessions, regular content updates that we email out to everybody. There's a 10 to 15% discount on services, access to the LinkedIn community group. And we get a lot of community members who talk to each other and do business with each other. So it really is it's a very worthwhile group to join. As testament by our first survey that we did, the independent survey we did the other day, we came back with some very good response rates and high promoter scores. So we're really, really pleased with that. We're very proud to support our member firms and their clients. And I'm here. I'm happy to reach out to anyone here who's not a community member that would like a bit more information and tell you a little bit more about how we can help you look after your clients. So in saying that, I think we'll wrap it up. Thank you so much, Peter, for your presentation, and to Joe for helping us put this together and inviting your subscribers. We'll get back to, there's a polling question there for you guys to answer. We'll get back to anyone whose question hasn't been answered. We'll make sure we get back to you, and everyone will receive a copy of this recording and the PowerPoint presentation following this webinar. So thanks again for joining us. It's been a pleasure talking to you. Thank you again, Peter, and look forward to speaking to you next time. Take care, stay well.